Okay, so today we're setting our sights on Constellation Brands, ticker CBI. We're doing a deep dive into their latest results, the second quarter fiscal year 2026 numbers, which just came out October 6th, 2025.
That's right.
And really, what we're trying to figure out here is this kind of stark contrast within the company. It feels like CBI has this dual identity right now. You've got the
hmm
beer segment, which is, the growth engine. It needs huge investment. But then the other side, wine and spirits, is going through this like radical and pretty painful overhaul.
Yeah, a complete transformation.
Exactly. So how are they funding both this big expansion and this big contraction at the same time? And they're also trying to hit this really ambitious efficiency goal, right, over $200 million.
That's the target, yeah. Over $200 million by FY28.
And the thing that just jumped out immediately, the hook, was the reported operating income. It shot up 171% year over year.
Which sounds amazing, right?
Pure growth.
Sounds incredible on the surface.
But then you look at the comparable operating income, the adjusted number for the whole company, and that was actually down 13%. So, okay, that huge difference. Let's unpack that right away for everyone listening.
Yeah, well, that initial 171% spike, it's basically financial noise. It's almost pure accounting cleanup, you could say.
Okay.
That huge reported jump is really skewed by a big goodwill impairment charge they took last year.
Yeah.
In the wine and spirits segment.
Ah, so prior year stuff.
Exactly. It's a non-cash thing, doesn't really reflect the day-to-day health of the business now. So if you filter that out, use their comparable adjustments,
Wow.
get to the real operational picture. And yeah, comparable operating income down 13%. And if you tie that to sales, overall organic net sales for the quarter down 8%.
Wow.
So the story is clear. You just can't look at CBI as one single thing right now. It's definitely a tale of two very different businesses.
Okay, so let's jump into the heavyweight champ then, the beer engine. That's what's fueling everything else, right? Despite all the economic noise, beer is still the core driver.
Absolutely the core.
But even there, Q2 showed a bit of, friction. Beer net sales were down 7%, and shipments, what they actually sent to distributors, fell 8.7% compared to last year. But then depletions, that sales from distributors to consumers, they only fell 2.7%.
Right, and this is a really key operational point you got to grasp. Shipments trailing depletions.
Okay, explain that.
It means consumer demand, the depletions, it's still holding up relatively well, but the distributors, they were actively pulling back on orders in Q2, rebalancing their inventory.
So they had too much stock.
Pretty much. They were sitting on a bit too much, so they tapped the brakes on ordering from CBI. It's like an inventory correction happening at the distributor level. It doesn't necessarily mean consumers are suddenly falling out of love with Modelo or Corona long term.
Okay, that makes sense. But what really stood out to me was where the growth that is happening is coming from. It's not across the board.
Right.
We saw Pacifico with depletion growth around 14%. And Victoria, even stronger, something like 19% growth.
Huge numbers for those brands.
But that growth, from those maybe slightly smaller brands, it contrasts sharply with the slight dips in the absolute core players. Modelo Especial was down about 4%, and Corona Extra slipped around 7%.
Yeah, slight declines, but noticeable for the flagships.
So, if your main anchors are slipping even a little, are they just relying on these smaller, faster horses to pull the whole cart?
Well, that's definitely the strategic bet they're making. But it's based on a trend that's proven pretty strong. The premium import segment is still really popular.
Okay.
And CBI is doing a good job capitalizing on that shift with brands like Pacifico. They were still the #1 new beer brand in dollar sales this quarter. And strategically, they're hitting other trends too, like non-alcoholic beer, where they were the #2 dollar share gainer.
So the underlying brand strength is there.
The strength is there, fundamentally, yes. But that strength is fighting a really tough battle on the cost side.
Okay, and this is where it gets really interesting, right? That operational friction. We know they're pushing hard on internal efficiencies, but how much good does that do when your external costs are just like soaring?
You absolutely nailed the tension there. Look, the company did well internally. They got a net benefit of almost $65 million in Q2, just from their own efficiency work, mostly in procurement and logistics. That's a big internal win, $65 million saved or avoided.
$65 million, yeah.
However, that $65 million was basically fighting an external tide that drove up the cost of their products by almost $43 million.
Wow, so nearly wiped out.
Exactly. They're running incredibly fast inside the building just to kind of stay in the same place financially. It suggests those efficiency targets, like that $200 million goal, almost need to be twice as effective just to counteract what's happening outside.
So break down that $43 million cost increase. What was the biggest piece?
Okay, three main things. First, the biggest chunk, over half, was $22.6 million straight from tariffs on aluminum cans.
Tariffs. Out of their control.
Totally out of their control. Political, regulatory stuff. Second, about $10 million was what they call unfavorable fixed cost absorption.
Okay, hang on. Unfavorable fixed cost absorption. For folks maybe not deep in finance, what does that actually mean?
Yeah, good question. Think of it like this. You have factories, right? They have fixed costs, maybe the rent, the depreciation on the building, salaries for core staff. Those costs exist whether you make 1 can or 1,000,000 cans.
Right.
You normally absorb those costs across all the units you produce. But if you produce fewer units, like they did this quarter, partly because distributors ordered less,
Okay.
then each unit has to carry a bigger share of those fixed costs. So it's basically a penalty for running the factories below full speed. It's the cost of having capacity sitting idle, even temporarily.
Got it. Makes sense. And the third piece?
The last bit was $6.7 million from higher depreciation. And it's directly linked to those massive investments they're making in the Mexico beer projects. Building new breweries isn't free.
Right, and that depreciation point, that leads straight to the future and this huge bet they're making. But wait, if Modelo and Corona saw declines, why are they doubling down so hard on more capacity? Isn't that ignoring the near-term softness?
Well, they're definitely looking way past just this quarter. Those capital expenditures, $217 million in Q2 alone,
Yeah.
mostly for beer capacity. They're betting the long-term trend of premium imported beer just keeps going up and up.
Okay.
The plan is for, get this, another 7 million hectoliters of capacity between now and fiscal 2028. They're aiming for about 55 million total hectoliters by then.
Wow.
So it's not really ignoring the weakness. It's more like a massive long-term commitment. But yeah, if the market does stay soft, they could absolutely end up with too much capacity. It's risk.
Okay, so that's the beer side. Powerful, but dealing with high costs and making huge bets. But to really get how they're funding all this, hundreds of millions in CapEx. We have to look at the other side, the side being, well, surgically taken apart. Wine and spirits.
Yeah, the contrast is stark.
This is where all that massive financial cleanup is happening. Reported wine and spirits net sales. Down a crazy 65%. That number is just huge.
But it's deliberate, right?
Oh, absolutely deliberate. That massive drop is almost entirely because they sold off big chunks of the business, the SVAKA vodka brand, and then those big 2025 wine divestitures, basically selling off a lot of their mainstream, lower-priced wine brands.
So they're shrinking the top line on purpose.
Exactly. Shrinking now, hoping for better profits later.
But even if you isolate the business they're keeping, the ongoing stuff, the organic wine and spirits, business net sales there, still dropped a painful 19%.
Yeah, and that 19% organic decline, that really shows the underlying challenge. It was a mix of, well, unfavorable product mix and just lower volumes. The company basically said it was due to weak consumer demand, both in the U.S. and internationally.
And the margins reflect that pain. Big time.
Oh, yeah. The operating margin for this segment just cratered. It went from a pretty healthy 18.1% profit margin last year down to a loss of negative 14.6% this quarter. Minus 14.6%. That margin swing is just, wow. That's the clearest sign of the restructuring hit. But the strategy is obvious. Ditch the lower margin stuff, focus only on the high-end luxury consumer.
Precisely. We're talking brands like the Prisoner Wine Company, High West Whiskey, and that new Sea Smoke luxury brand they bought. Ultra premium.
But getting there involves taking some hits financially, right?
Absolutely. To make this pivot, they had to swallow significant costs and losses tied directly to selling off those other brands. They took a $52.1 million asset impairment charge this quarter related to those divestitures and some contract liabilities.
$52 million.
Yeah.
Why take that kind of short-term punch? That seems like a massive cost just to refocus.
Well, it's kind of the necessary evil, the cost of getting leaner and aligning with where they see the consumer going towards premium stuff. They're basically accepting big losses right now this quarter to get rid of assets that were frankly dragging down the whole company's performance.
Low growth, low margin stuff.
Exactly. The goal is to come out the other side beyond fiscal 26 with a much smaller wine and spirits business, but one that's growing faster and has much better margins, and one that won't distract from the main beer engine. It's a strategic sacrifice, really.
Okay, so you've got a company pouring hundreds of millions into beer while taking tens of millions in losses to tear down and rebuild wine and spirits. Let's zoom out then. Segment 3, corporate level. How are they managing the money side of this intense kind of dual strategy?
Good question.
First thing, financial discipline. They kept their comparable net leverage ratio target around 3.0 times. Why is that specific number important?
Yeah, that 3.0x leverage ratio, it's a key signal of financial stability. It basically means they're comfortable with their debt level relative to their earnings.
Okay.
And it's critical because, like you said, they're pouring so much money into CapEx for beer. Keeping that leverage steady shows they believe the future cash flow, mostly from beer, is strong enough to handle both the restructuring pain and the huge expansion spending without getting, dangerously over-leveraged.
And they're definitely not forgetting shareholders through all this turbulence. They declared a dividend, $1 per Class A share. Plus, they bought back almost $300 million of their own stock in Q2.
Yeah, $298 million in Q2 brings the total this fiscal year to over $600 million already. They still have a big $4 billion authorization running through fiscal 28.
So what does that signal?
Well, it signals huge confidence in future cash generation. They're basically telling the market, look, we believe so strongly in the long-term beer story and the outcome of the wine cleanup that we can build new breweries, take these restructuring hits, and still return a lot of capital to you, the shareholders, all at the same time.
But maybe the most critical piece tying it all together across the whole company is that 2025 Restructuring Initiative. This is that huge internal efficiency push we mentioned.
Right. That's kind of the glue holding the whole financial picture together. It's enterprise-wide, hits everything from procurement to back office admin stuff. And the target is massive. Over $200 million in net annualized cost savings by fiscal 2028.
That's a huge number. How are they doing so far?
Well, they've spent about $71 million in pre-tax costs to get those savings since they started, mostly hitting their SG&A expenses. But achieving $200 million net savings by 2028, that's a really heavy lift.
Yeah.
This isn't just, cutting travel budgets. This means deep organizational changes, restructuring teams, really streamlining how they operate. That's often way harder, more disruptive than just selling off a brand. But they expect most of the hard work for this to be done within this fiscal year, FY26.
Okay, and finally, we have to put this all in context. The macro environment. They reaffirmed their full-year earnings guidance, that comparable EPS target of $11.30 to $11.60. But what external clouds are on the horizon?
Well, they listed the usual suspects, potentially subdued consumer spending, ongoing inflation, geopolitical uncertainty, even severe weather affecting supply chains, standard risks.
Right.
But one specific regulatory risk really stood out in the materials, something called the OB3 Act. It was signed into U.S. law back on July 4th, 2025.
OB3 Act? What's that about?
It's a tax law change. And management specifically said they believe it's going to negatively impact their effective tax rate for this fiscal year, fiscal 2026.
Oh.
It changes the rules around how much interest expense companies can deduct from their taxes. Basically, it makes borrowing slightly more expensive from a tax perspective. So it hits the bottom line, regardless of how well their beer actually sells. An external headwind, pure and simple.
Okay, so let's try and recap the core tension here. You've got Constellation Brands fighting to defend its beer market share, pouring huge money into that premium beer segment. At the exact same time, they're doing this very painful, very deliberate cut down of their wine and spirits side to focus purely on luxury.
Yeah, the future really hinges almost entirely on beer's ability to, first, successfully absorb those rising costs, the aluminum tariffs, the cost of that extra capacity, while this whole wine restructuring plays out over, say, the next 18 to 24 months. They're actively choosing financial pain now for what they hope will be much better growth and margins later on.
Which, I guess, leaves us with a final thought for you, the listener, to chew on. The beer business specifically mentioned that distributor inventory rebalancing caused shipments to lag behind consumer sales in Q2. That signals caution from distributors, right?
Definitely suggest caution at that level, yeah.
Okay, so given that caution and the ongoing massive investment in new brewing capacity, they're planning for another 7 million hectoliters, plus the company's own warnings about potentially subdued consumer spend. How should we think about the balance between that huge planned supply increase and potentially shaky consumer demand in the near term?
Well, yeah, that's the tightrope walk, isn't it? If consumer confidence dips unexpectedly or stays soft for longer than they anticipate, they could find themselves sitting on a lot of very expensive, underutilized brewing assets.
Definitely a metric worth keeping a very close eye on over the next few quarters. A huge thank you for joining us on this deep dive.
My pleasure.
We'll catch you next time.